Meeting minutes published today highlighted that Bank of England Governor Mr. Mervyn lost his final stimulus vote for a quantitative easing top-up at the June MPC meeting. David Tinsley of BNP Paribas joins me now. David, while this is not wholly unsurprising, is the fact that the current head of the central bank has been consistently amongst the minority on this vote since February a suggestion that Mark Carney's takeover next month could stimulate fresh monetary discussion, or more simply a sign of a confused outlook for the British economy?
Well, I think in some respects it's both. We do expect Mark Carney to bring about more stimulus in the UK, although not at his first meeting, not at the July meeting, and that's largely because the UK economy, while it's growing, is doing so at a fairly modest pace, really, and at the same time cost pressures in the UK, particularly when you look at wage growth, are very subdued. But different MPC members see things in different ways, of course, and Mark Carney will still need to convince a number of MPC members to change their vote, and that's something that Mervyn failed to do in the last few months of his tenure.
The outgoing governor will give his views on the economy when he delivers his last annual Mansion House speech in London this evening. What can we expect?
I expect, given that this is his last speech, as you say, it will largely be a historical retrospective on some of the challenges that central bankers have faced over the last few years. It may well focus much more on financial stability aspects of that and macroprudential ones rather than on monetary policy considerations. Certainly Mervyn will not say anything that ties Mark Carney's hands at the meeting tonight, and so I think in many respects it will be much more of a big picture discussion.
UK CPI figures released yesterday highlighted a rise to 2.7% in May from 2.4% in April, still well above the 2% BoE target. Some analysts have anticipated an inflation rise as far as 3% in the next few months. Would you agree, and what will the knock-on impact be for the domestic economy?
Well, I would agree. I mean, there are a number of factors pushing up on the year-on-year rate of inflation over the next few months, largely in relation to base effects as they drop out rather than any new data coming in. So food price inflation was actually quite soft over at this time a year ago, and petrol prices were falling faster this time a year ago than they are expected to do over the coming months. So we expect UK CPI to peak at around about 3.1% in June and come down thereafter, provided we don't see a noticeable spike in domestic food price inflation, which is possible. In terms of the knock-on effect on the economy, well, you have to take this higher inflation in conjunction with the very weak average earnings growth we're seeing, and I mean, our concerns really are that in aggregate, it's quite hard to see much real income growth in the UK, even when you take into account the fact that the labour market is generating employment growth. So I think what this underlines is that there are some risks to consumer spending in the second half of this year and into 2014, which could in turn mean that growth figures disappoint after the second quarter.
Despite a slight dip this week ahead of today's minutes, the British pound has strengthened at 3.3% in the last 3 months, the best performing of the developed market currencies after the euro. Do you foresee this performance continuing, and what are your forecasts?
No, we don't. I mean, our policy call as far as the Bank of England is concerned is that they will do quite a lot more easing over the coming months, in response to weak cost pressures, the global position, market volatility, and the fact that Carney is likely to be on the activist side. And we think that's going to take the edge off sterling. So our currency forecasts see euro sterling against the dollar falling to 1.43 at the end of 2013, and indeed some renewed weakness against the euro as well. So really this run of good form that the pound has had, we see petering out.
David, many thanks for your comments. I'll be back tomorrow with a look at US market response in the wake of the FOMC meeting. Goodbye for now.